Have you ever wondered if the biggest investment opportunity since the internet is happening right now, right under our noses? Well, today we're going to dive deep into the world of crypto assets, and we're using the Innovative Investor's Guide as our map. So whether you're a seasoned pro or just kind of crypto curious, let's get into it and figure out what all the fuss is really about. Here's what we've got lined up. First, we'll jump back in time to the 2008 financial crisis that, believe it or not, kicked this whole thing off. Then we'll check out the massive sprawling universe that grew from that one single idea. After that, we'll tackle the big question. Is this stuff a whole new asset class? And finally, I'll give you an investor's survival guide for navigating this wild new frontier. So, where does this whole story really begin? Well, it's not with some tech genius in a garage. It actually starts with a full-blown global financial meltdown. Seriously, to understand crypto, you first have to understand what went down in 2008. Cast your mind back to 2008. The entire financial world was shaking. Bear Stearns just collapses. A few months later, Lehman Brothers files for the biggest bankruptcy in U.S. history. This wasn't just a dip in the market. It was a total breakdown of trust in the system. And then, right in the middle of all that chaos, this anonymous paper pops up online, proposing a completely radical new kind of money. And this quote right here from the mysterious Satoshi Nakamoto, it just gets right to the heart of the entire idea. The 2008 crisis showed everyone just how fragile a centralized system can be. So the goal was, simple, but also revolutionary. Create a financial network with no single point of failure. No CEO, no government, no central bank that could mess things up. So, what's the engine that powers this new system? It's called the blockchain. The easiest way to think about it is like a digital record book that's copied and shared across thousands of computers all over the world. Every single transaction is locked in with some seriously advanced math, and once a record is in there, it's pretty much impossible to change. All of a sudden, you don't need to trust a bank. You can trust pure code and mathematics. But that one radical idea, Bitcoin, that was just the spark. It became the seed for this huge, sprawling digital ecosystem that goes way, way beyond just a single digital coin. Yeah, so the crypto world quickly grew beyond just digital money. It kind of split into three main buckets. You've still got your cryptocurrencies like Bitcoin, but then you got what are called crypto-commodities. Think of these like digital raw materials. A perfect example is Ethereum's Ether, which is literally the gas that makes its network run. And finally, you have crypto tokens, which are more like the finished goods built on top of those networks, giving you access to a specific app or service, like the Augur prediction market. Now, one of the most powerful ideas to come out of all this is the smart contract. But honestly, the name is a little misleading. Don't think about lawyers and legal documents. Instead, think of a vending machine. It's simple, right? If you put in your money and you press the right code, then the machine gives you your snack. Smart contracts are just that same if-then logic, but they run automatically on a blockchain, which just opens up a whole world of possibilities. Okay, so that's the what, but let's get to the why. Why should you, as an investor, even be paying attention to this? Let's dig into the case for crypto as a brand new asset class. Do you remember the early 90s? The internet was this weird, clunky, nerdy thing that most people just kind of dismissed. But the very few people who had the foresight to invest in a tiny online bookstore called Amazon or a search engine called Google saw absolutely life-changing returns. A lot of people believe we're in a very similar moment right now with crypto, a fundamental tech revolution that's really just getting started. Okay, to really get the investment side of this, you have to understand a super important idea from modern portfolio theory, correlation. It's just a fancy word for measuring how two different assets move in relation to each other. So if stocks go up and bonds go down, they have what's called a negative correlation. The absolute holy grail for any investor is finding assets that have little or no correlation to everything else in their portfolio. Why? Because that's the secret to real diversification. And this is where it gets really interesting. Historically, crypto assets have kind of danced to the beat of their own drum, showing very low correlation to traditional things like stocks and bonds. And the data shows this. Look at this. Adding just a tiny 1% slice of Bitcoin to a regular portfolio back in this period actually improved its overall risk-adjusted returns. That right there is the power of diversification in action. All right, so you've got the what and the why, but let's be real. This is a very volatile world. So now let's talk about the how. These are the mental models you're going to need to navigate this space and, survive the ride. This right here is Gartner's hype cycle, and it is an amazing map for understanding any new technology. It always starts with an innovation trigger. That's the Bitcoin white paper. Then you hit the peak of inflated expectations, where everybody thinks this new thing will solve every problem in the world. Of course, that leads straight to the trough of disillusionment, when reality kicks in and people start calling it dead. But for the technologies that have real substance, they start to slowly climb the slope of enlightenment towards real use and eventually hit the plateau of productivity. Just knowing this cycle exists helps you stay level-headed through all the wild swings.
So what actually drives the price of these things? Well, it's really a tale of two different values. On one hand, you have utility value. This is about what the network is actually being used for. Is it processing a lot of payments? Is it powering a bunch of apps? This is the fundamental real-world demand. On the other hand, you have speculative value. This is purely driven by the belief or the hope that it's going to be worth a lot more down the road. And in young emerging markets, that speculative value often completely dominates.
And if you want a perfect and kind of painful lesson in what happens when speculation gets totally disconnected from reality, look no further than the Dutch tulip bubble. Pure hype and frenzy drove the price of a single tulip bulb higher than an entire house, right before the market completely and utterly crashed. It's the timeless warning that what goes up on hype alone must eventually come down.
And that leaves us with the single most important question you as an investor can possibly ask. When you look at any crypto asset, you have to ask how much of its price is based on real tangible utility and how much is just pure speculation, a modern-day tulip bulb. Watching for that shift from speculation to real-world use, that is the whole game. And knowing the difference is what separates smart investing from just gambling.